Hello and welcome to today's webcast, Energy Accounting and Tax Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1.5 CPE credits. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 75 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only one sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
We have several great speakers with us today, and their bios and contact information are located in your webcast console. To get us started, I'd like to turn the floor over to Lori Mattil, Moss Adams partner and Oil and Gas National Practice Group leader. Lori.
Thank you, Danielle. Welcome, everyone. We are happy to have you all joining us for our Energy Accounting and Tax Update today. We do have a lot of topics to cover during this webinar. So these are meant to be at a very high level, just things that we think you should know going into the next few months. We do intend to have some future webinars to go into some of these topics more in depth, but we do encourage you to go ahead and use the Q&A. We'll do our best to get to those questions on the webcast, but if we don't, someone will follow up with you. With that, it's my pleasure to introduce our first tax speaker. I'll be serving as the MC. You can see all of their pictures up there, but I'll introduce each one during their section. So with that, first up is Matt Kaden, who's a managing director in our M&A tax practice here at Moss Adams, and he's going to give us an update on where things stand with the IRA. With that, I'll turn it over to Matt.
Thanks, Lori. Good morning, everybody. Good afternoon, depending on where you're situated today. Just want to start off with a brief overview. The stuff seems kind of old hat to me at this point, but it is still fairly new and there's a lot that's gone on. So just to kind of lead off with an overview, this is the Inflation Reduction Act, obviously enacted in August of 22. The initial sort of figures were maybe $400 billion over 10 years related to these tax credits that we're going to discuss today. But I think, in the light of further analysis, I think those numbers are creeping up. There's been some analysis that it's perhaps $1 trillion over that period of time, perhaps $3 to $4 trillion. I've seen estimates. So really could be sort of a runaway type package of incentives. So it's a big deal. And as we'll discuss here, it impacts pretty much every corner of the economy. So, historic investment, obviously, in domestic energy production and manufacturing. Three goals, I think, overall: facilitate the energy transition away from fossil fuels. Number two, domesticate the renewable supply chain. Number three, enhance energy security. Everyone saw sort of the Ukraine and sort of German winter issue of 22 were in people's mind, certainly when this was being negotiated. Extended and expanded a number of clean energy credits and created several new credits. So if you knew something about the credits before the IRA, quite a bit of that changed or was expanded or enhanced. And then there's also new credits that were not in previous legislation. A big part of this is not just having the credits available or creating new credits, but actually finding ways to monetize those credits. Tax credits really are only useful historically to taxpayers with taxable income. And so developers and other parties who develop these large CapEx intensive projects don't have a lot of tax capacity due to accelerated depreciation and other tax benefits. So real focus here was develop alternative ways to finance and monetize those credits. And two new avenues were developed, and we'll talk about those, one being transferability, one being direct pay. It's not just a pure sort of green industry play. There are benefits, and very significant benefits, for companies that are experienced in oil and gas technologies as well, including incentives for carbon capture and different clean fuels and renewable natural gas. 2005 is an important sort of baseline level when they talk about sort of the climate impacts of this stuff. So that's basically based on the Paris Agreement, which had a goal to cut global greenhouse gas emissions by 50% off of 2005 levels by 2030. And if we go to the next slide, a chart on the left, down at the bottom, you'll see in sort of faint gray writing on the left, U.S. Paris Agreement 2030 target, 50 to 52% 2005 levels. So we're not there. We're currently sort of on track with that blue line, the blue shaded region. And then the region below that is kind of the expectation of where we're going to be in 2030 with the Inflation Reduction Act. So basically getting us essentially halfway from where we are currently to the sort of U.S. Paris Agreement target. And just to give sort of a sense, where we are now on sort of a cost of technology basis, this is levelized cost of energy, which is not perfect because it doesn't take into account, like availability and the fact that, for example, the sun doesn't shine at night. But as a rough measure of sort of how efficient these technologies are from a cost perspective, you can see that the light blue is basically where these technologies were before IRA. So solar and wind, for example, cheaper on a levelized cost of energy basis than is gas, and then made even more so by the IRA, which is the dark blue. And so you can see that really the big winners here are hydrogen. So hydrogen going from basically a completely uneconomic proposition before the IRA to something resembling natural gas currently. And then carbon capture as well through expansion of credits that we'll talk about is also much more economic. So I'm not going to walk through all this whole slide, but the point is, whoever you are in whatever organization you represent probably are going to have some tie-in, some opportunity with the benefits that are available under the Inflation Reduction Act. That could be, obviously renewable energy companies, but do you own a business that uses energy, right? You're gonna have to think about what those benefits are as you determine, okay, am I gonna put this on my property? Am I gonna own this energy property? Am I gonna own that solar facility that's going to power my business? What kind of offtake arrangement? If I'm not going to do that, how is that impacted by these incentives? If you own an oil and gas business, we talked about sort of the different carbon capture and clean fuels opportunities are going to be available, highly lucrative there. And industrial business, if you're manufacturing something, can you tweak your manufacturing process to manufacture things that qualify for incentives under the Inflation Reduction Act, different steel tubing and other things that qualify for additional incentives above and beyond what you're getting from your customers. And then third, do you want to reduce your tax liability? That's many people probably on this call. And with transferability now, there's an easy way for folks with tax liability to make an investment and get a very handsome return in a short period of time that is very minimal risk, right? Almost a risk-free return by buying credits at a discount. You have $100 of tax liability, you pay $92 for the credits, and then you satisfy your tax liability the next day. You've made a quick 8%, obviously, in that situation. And then for nonprofits, completely different landscape now. You, even without any tax liability at all, nonprofits are eligible for direct payments of cash from the government for these tax credits. So if you have facilities and you want to upgrade them or repower or refurbish them, you have to take into account the opportunity here. Is this something where we can earn cash, get a return right away of our capital that wasn't there previously? So sort of whoever you are, there's some benefit to be had. I turn it over to Danielle for the first poll question.
Fantastic. Thank you. So here's our first poll. Has the IRA impacted your business? A, absolutely. B, no. C, still curious what the IRA is. The polling questions are located right on the slides we're presenting. If you can't see it, you can hit the F5 key to refresh your console. Reminder to respond, please click the button next to the answer you choose and hit submit. If you would like to receive CPE credit for today's webcast, you will need to respond to at least 5 of the 6 polling questions. And I'll leave this up for just a moment longer. And the results. Matt, back to you.
Thanks, Danielle. So it seems like about 60% still kind of unimpacted or curious. So I just want to hit a quick question before we move on. There's a question that I just got in the inbox. As a nonprofit, how does the direct pay process work? We don't have federal income taxes. How does this work? So long story short, you can file whatever your return is. If let's say you're a 501c3, a 990, and there's a registration process and a way to file for this actual cash payment when you make that return. So you don't actually have to have any federal income tax liability to benefit from direct pay. So early returns, obviously, we're seeing a lot of things that were meant to be incentivized. So domestic manufacturing, we're seeing, again, companies that already manufacture domestically ramping up their production in these other areas. Foreign producers of components for renewable energy, sort of onshoring their operations in the U.S., all to take advantage of these credits. We're seeing a spike in demand for construction worker wages. These credits are now tied to paying your workers a prevailing wage. So there's basically a big incentive to do so. And then also there's further benefits for using domestically sourced content if you're a developer of renewable projects. And so we're seeing quite a bit of that as well. The transferable tax credits, now that the IRS has opened up the portal under which you can sort of make those transfers effective, we've seen a lot of those transactions happening. I'm working on several right now myself. And a lot of that uncertainty that was there in the early months after the IRA is starting to subside, although there still remains a substantial amount. Some long-term headwinds, obviously high interest rates are going to impact CapEx intensive industries like renewable energy. Domestic wind and solar is still constrained by permitting queues and interconnection queues. And then sort of there's challenges, as you probably read about, with offshore wind and demand for EVs, which is going down a little bit recently. Quickly on energy tax credit basics, you've got an option, basically an investment tax credit that's based on your investment amount, or a production tax credit, which is based on what you produce. And so there are quite a few projects, solar, wind, biomass, renewable natural gas, that could qualify for both, right? And so it's kind of a modeling exercise. Do you want to take that one-time investment tax credit based on your investment, or do you want to get paid as you generate over 10 years? And so that's kind of the predominant choice that is sort of made up front on these types of credits. Just a quick and simple calculation on a $100 million project is to show you how the credit is calculated. You would get a base credit amount of $6 million. When you meet that prevailing wage hurdle, you would achieve another $24 million in bonus credits. If you use domestic content to a certain degree that's required, it's about 40% of your overall cost for most manufactured components, you'd receive another $10 million bonus credit. If it's located in an energy community, which if there's a map that the IRS puts out, the Department of Energy puts out that's showing where these energy communities are, and they cover a wide portion of the country, that's another $10 million. And then if it's located on a low income or tribal land, still an additional $10 million. So possible to have a return of capital, of $60 million within sort of the first year for an ITC project based on the IRA. Not too shabby. Transferable tax credits. Again, we talked about this. This is a way that benefits not only the developer, because they can monetize this important, valuable asset that they have, the tax credits, but also for investors, which is basically anyone with a tax liability currently or that forecasts one in the future. So again, the project company is going to develop the project. It's going to generate tax credits. It's going to sell those credits at a discount to a buyer. And that discount's kind of moving around. It depends on a number of different factors, but this 9.2 million or 8% discount is not out of line with what we're seeing. So the developer ends up with $9.2 million. It has to bear the cost of kind of the transaction. So paying lawyers and tax insurance and things like that comes out of the project coffers, but the developer ends up with $8.4 million that it wouldn't otherwise have because it can't use tax credits. And the third-party buyer gets a quick return of 8% on its investment with very minimal risk. Still some limitations for individual buyers or partnership buyers, S-corp buyers, but corporate buyers with tax liability are sort of available to take full advantage of this. Direct pay, talked a little bit about it. Again, just totally novel, right? Something that people that run 501c3s that are part of state and local governments or tribal governments or even Alaska Native corporations or rural co-ops. Now, regardless of whether you have tax liability or not, if you own a project, you can get a direct cash payment from the government, generally in the year following its place in service date. And that's just a huge change. And we're seeing lots of different interesting structures, joint ownership structures, different financing structures that kind of allow for these projects to get developed and for the non-taxable entity to take advantage of the direct pay benefit. So that's really exciting and is helping projects get built that otherwise wouldn't get built. There is some direct pay. Generally, this is a tax exempt entity concept, but there are 3 code provisions, 3 credits that allow for taxable entities to take advantage of direct pay, so to receive direct cash payments. And those are carbon capture, which is 45Q, advanced manufacturing, which is generally manufacturing components for renewable energy projects, and then 45V, which is hydrogen production. All 3 of those allow for 5 years of cash payments. And then I think the thought is either the government will extend that for another 7 years, or it would be necessary for those developers to find some other way to finance those credits after that 5-year period. some significant complexities exist, like exactly how is this going to work? What standard of proof is the IRS going to require before it sort of writes a check? The 1603 cash grant program was a program that was in effect, similar program from 2009 and 2011, which got a reputation for being a little bit stingy and sort of not giving the taxpayer the benefits they were expecting. So we'll have to see sort of with experience whether this process works well or not. The other thing is sort of application of direct pay if it's a joint venture, still in flux. A tax partnership does not qualify for direct pay. And so kind of have to work around that using joint ownership structures like tenants in common or other sort of arrangements that aren't tax partnerships. Just to wrap up here on where we are from a guidance standpoint, we have, after many years, proposed ITC regulations, which really get into detail on the types of equipment that for all of these new technologies, there's some new technologies include battery storage that isn't charged by solar, renewable natural gas. There are a few others that, okay, which components exactly qualify for the ITC? And so with a renewable natural gas facility, if it's kind of getting fed by waste and then it has a digester and gas treatment, it has all these different components, sort of which of those qualify for the ITC. The credit transfer regulations, I think they were pretty clear. I think they have helped facilitate transfers of credits between developers and taxable buyers. The direct pay regulations, still some really key open questions. I hope they'll be addressed in final regulations. Prevailing wage and apprenticeship, again, on how you sort of pay workers, how you track that, how you comply with the apprenticeship provisions. Very, I think, useful guidance already issued. And then proposed regulations on advanced manufacturing, clean hydrogen, and advanced energy products, also very helpful. There's some early guidance on energy communities that was very, very helpful. There's a map that you can just sort of go to and get a quick feeling for whether you qualify for that bonus. And then low-income community regulations for that additional 10% have been issued. So I think at this point, still some open questions on direct pay and some of these newer credits, particularly the hydrogen regulations, which are in proposed form. But so far, the IRS has really stepped up and delivered a lot of helpful guidance to get the wheels moving on this stuff. And with that, I turn it over to my colleague, Marty Cheetah.
Thanks, Matt. Actually, I'll do a quick intro of Marty. Marty Cheetah is a partner in our state and local tax practice. He will have some updates, I guess, continuing on the IRA theme with regard to the methane tax, or really a fee, I guess, that came in with the IRA, as well as some property tax updates. I'll turn it over to you, Marty.
Thanks, Lori. So let's get into it. The methane emission reduction program, this is part of the IRA. As Lori mentioned, is it a fee? Is it a tax? I don't think matters how you define it, but you could see why the EPA, and I'll do a little science here as a tax accountant, of why they're trying to focus on methane versus carbon dioxide. For carbon dioxide, right, we all know carbon dioxide, CO2, it can last in the atmosphere for hundreds of years, where methane, a lot shorter life, maybe 10 to 20 years. But methane's really good at trapping heat. In fact, it's 80 times as traps more heat than carbon dioxide. So what we're looking for in this carbon capture technology, but methane abatement, is the idea to not even release the methane into the atmosphere. Methane is very hard to capture compared to carbon, and therefore the focus here is limiting methane being released from the start. The idea is to say, if we can keep this methane from even coming into the atmosphere, we could greatly reduce any type of heating going on in our atmosphere. The rules are still coming out. December was more of a technical update. We even had a new update January 12th from the EPA talking about best guidelines and technologies on how to reduce methane, specifically in oil and gas. And there are a number of items how to do this. We're seeing it by basin being differently done, right? When we're seeing pneumatic pumps, particularly in Colorado, we're seeing a lot of operators that are moving from natural gas driven pumps to electrified pumps to reduce emissions. As we get into the super emitter program, for super emitters that produce a lot of CO2 and methane, there was additional clarity on how the EPA is going to treat this, particularly when we look at third parties. The third parties that are going to come in and monitor any type of super emitters. Previously, it was thought that they could go on site and monitor this on site, where we've had additional guidance where these third parties could only do it remotely. So we're going to see a lot of drone usage and camera usage to monitor emissions here. Further, these third parties cannot directly go to the emitters. They have to function through the EPA itself, and they all have to be approved and licensed through the EPA. Now, as far as reporting, I would assume many people on this call might actually already be reporting to the EPA under Subpart W. This is at a 25,000 metric ton CO2e or carbon dioxide equivalent. So if you're emitting 25,000 metric tons per year, you're generally already going to be reporting to the EPA. So many of the same definitions are being utilized under Subpart W and being applied to this methane reporting. Different industry segments such as onshore, offshore processing, and producing natural gas and oil throughout the U.S. Now, I think it's an important thing to think that the 25 metric tons is simply a reporting piece where the tax and the fee is really on the methane being emitted. Now, there's different waste emission thresholds by type of industries, as well as the facilities. An interesting segment on the facilities, it is 25K metric tons, and that's done by basin, where when you're onshore looking at by basin compared to offshore, each offshore platform in definition is its own facility. So there's a lot more reporting, and the requirement is lower for onshore production compared to offshore production. Now, there's different charge amounts by year, and there's different exemptions that could be done. Particularly, I'd like to point out plugged wells. Once you plug the well, generally that's not going to be subject to any methane reporting fee or fees going on at that point. So as I mentioned before, there's different issues by different basins depending on that state regulatory standpoint. And how we're seeing some operators work and try to lower their emissions is both from a societal pressure as well as on the methane fee and tax itself. Seeing a lot of natural gas driven pneumatic devices being replaced. Not an operations person or engineer, but seeing some ideas being floated on how this methane could be reduced, looking at IAA skids and even nitrogen bottles that might have to be refilled every single month to reduce emissions. So here's the fee, here's the tax. You can see it starts in 2024, pushing out to 25 and 26, going to 900 all the way up to 1,500 per metric ton. So I would say overall for the methane reporting standpoint, a lot of companies are already reporting. This is just going to be an additional standpoint as well as adding in a tax or a calculation. So I'd really encourage you to work with your operations and regulatory team on how you're going to address your methane reporting and tax in the future. Now we're going to move to our next polling question.
Thank you, Marty. So poll question number 2, is your business required to assess the methane tax? A, yes, B, no, C, no clue. You do have the option to submit questions for the presenters in the Q&A window. We have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. And a reminder that these polling questions are located in the slide deck and not the video view. So if you've minimized, please select that icon towards the bottom of your screen to get these back up. I'll leave it open just a moment longer. And the results, Marty, I'll pass it back to you.
Thanks, Danielle. Now, my favorite topic, property tax. We're going to go into oil and gas, power and utilities, and then renewables, and a quick slide for the opportunities available for each one. In oil and gas, when we report for property tax, it's basically done on two different methodologies, either discounted cash flow or the actual value produced in a prior year or a prior month. Discounted cash flow, we're seeing this in Utah, West Virginia, Texas, Louisiana. And then the value reporting is coming more from New Mexico, Colorado, Wyoming, Oklahoma, of course, being DCF as well. So the appeal opportunities for both can vastly different. For DCF, what we're looking for when these third parties produce any type of fair market value approach, they're probably typically using basin standards or industry standards. So really comparing with that notice of valuation as it comes through, comparing it to your specific decline curves and your specific operational expenses, and making sure those align with the assessment. For value reporting, this is looking to really trying to accelerate deductions that can match up with the revenue coming in for that particular year. We do this by looking at any scrubbing and making sure we're taking the right percentages on our LOE accounts, as well as trying to accelerate depreciation and return on investment, again, to better match deduction to income. Now, going back to DCF, I would say in particular states, there's greater opportunity. When we look at Texas and Louisiana, generally those are the best bang for your buck when you protest, and typically seeing 90 to 95% of all companies protesting their property tax assessment because of the overassessment by these third parties. M&A, it's a hot topic in oil and gas. And so if we do have M&A coming in, I would really look at seeing what your notice of valuation value is to what you paid for those particular properties. If we see a large difference, there might be opportunity to protest that and get a lower property tax value for current year and continuing on for future years. For power and utilities, this includes both power generation, water, sewage, and this is generally done by centrally assessed property measure. This is done by the state. And we look at three different methodologies in property tax, but particularly within power and utilities, we're really looking at two. Income versus cost methodologies, where the income is the overall generation of income year by year, and the other is cost. What did you pay for it, less some type of depreciation, plus increasing replacement costs. In looking to see which one better reflects how your property should be valued. For example, in income, generally we see a lot of 5-year look-back periods for income. Maybe there was an operational change 2 years ago, so we should be using a 2-year look-back versus a 5-year look-back. On the cost side, are we looking at all the obsolescence that could be available? Simply taking this to a pipeline, or even using it even easier on an apartment complex, if we're not having 100% of our apartment being utilized and we're at a 50% occupancy, we shouldn't be paying 100% of the tax. From renewables, tying into what Matt Kaden said, and this is a very powerful piece here on the renewable side, is the cost basis of these assets. Typically, it's what you paid for it. But there's certain writings in certain states that, certain statutes in certain states that will allow you to reduce this cost by the ITC. So instead of those solar panels costing $100, you could actually reduce this cost down to upwards of, Matt showed, 60% down to 40%, $40. And therefore a great reduction in property tax for current and all future years. Cost method and the asset lives. Again, we see a lot of, just for ease, these jurisdictions utilizing tables in generic, hey, we think a solar panel will last 25 years. And many of us know that a solar panel will be replaced much greater than 25 years, particularly on the wind side too. And therefore, deviating from those tables are allowed, and setting a good stage and setting a good argument with your engineers and operations to say we should be utilizing a 7-year life on our solar panels versus a 25-year life will accelerate depreciation and overall lower your property tax liability. And the third and final thing is on new projects and current projects. Do a lot of work on, especially with the IRA coming in, hey, what am I going to pay for property tax every single year? It is one of the biggest operational costs for renewables is property tax. And therefore, ripping out some of the intangibles that should not be subject to property tax can can result in substantial benefits, software costs, some of the engineering costs or permitting. All of these, depending on the jurisdiction, might be able to be removed from your cost basis and therefore reduce your overall property tax liability. That's my update on property and methane. Back to you, Lori.
Thanks, Marty. So now, I guess, turning a little bit from the IRA, we're going to turn to Daniel Kemp, who's a senior manager in our R&D tax practice. And Daniel's going to go over just some reminders maybe for activities that may qualify for the lucrative R&D tax credits. Daniel?
Awesome. Thanks, Lori. As Lori mentioned, my name is Daniel Kemp, a senior manager in our R&D practice. I have about 9 years of experience in the R&D space, and that's what myself and our group, that is what we specialize in. We only work on R&D credits here at Moss Adams. So to kick us off, first going to discuss the four-part test. The four-part test is the qualification criteria in order to claim an R&D tax credit. All four of these items must be met. It's not a 3 out of 4, 2 out of 4. It's a 4 out of 4 in order to claim an expense and claim a credit off those expenses. The first piece of this is a qualified purpose or a business component. The development of a new or improved business component, which is a product, process, software, technique, formula, or invention. And it must be created in order to improve the functionality, performance, reliability, or the quality. Next, you have to have an elimination of uncertainty. What that means is you have to have uncertainty regarding the capability, the function, or the design of your business component. And that leads to step 3 is the process of experimentation. What does your process look like in order to evaluate and eliminate your uncertainty? You have to go through some examples or modeling, simulation, trial and error, items of that nature in order to try to get your project to work. And then finally, everything has to be technological in nature, meaning you have to be rooted in hard sciences. It can't be market research or social sciences. And then we have on the right side of this slide, we have which expenses actually qualify. It's wages that you pay to your employees. It's supplies that you may be incurring for either prototype development or for pilot models. Computer leasing, it has to do with software development companies where you actually lease space on an Amazon or a Google server where you actually use that as a development environment or a testing environment. And then finally is contract research, where you have 1099 individuals that still perform work, R&D work for you. They're just not employees. And we'll move on to some actual examples. But first, wanted to bring up that the R&D credit is a federal or domestic credit. So the credit is based on all domestic expenses, but there's also several state credits that are available. And this is our list of state credits. Each state has a different calculation and has a different percentage. But for example, the Texas R&D credit has to do with your franchise tax. It offsets half of your franchise tax. And then California is probably the most profitable from a percentage standpoint. It's probably it's oftentimes even greater than some of our clients' federal benefit. And moving on to our next polling question.
Thank you, Daniel. Poll question number 3. Does your business have any R&D expenditures? A, yes. B, no. C, not sure what type of expenditures are considered R&D. For those of you that would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts. We will also be sending them out via email tomorrow, along with a recording of the webcast. I'll go ahead and leave this up for just a few more moments while we get some final responses. And the results. Daniel, I'll pass it back to you.
Awesome, thank you. And there was one question that came in during the polling question. So would an updated software implementation project for accounting group in an oil and gas company count? The answer, it depends. It depends on if it will meet that 4-part test. So if you want to talk more about it, please reach out and happy to discuss specifics. But the answer is depends. So what are some industry examples? So I broke this out in the different areas of oil and gas. So first, focusing on the upstream side with kind of the exploration and production companies, there are R&D credits available to drilling processes and completion designs. There's been some movement and development within the R&D space where we're able to go after credits for developers that are actually going into new fields or even existing fields and working on enhanced oil recovery techniques, redesigning their drilling process, redesigning their completion process, whether that be new designs, new technology, different spacings, kind of topics like that. There are opportunities now within the upstream space to actually go after and calculate some credits. And from our experience, these credits can be very substantial. In the midstream space, focusing on kind of the construction of the different facilities and pipelines. There's a lot of development that goes into that from a R&D space, typically because of all of the different environmental constraints you have to worry about. There's a lot of different materials you have to do, different mechanical systems and designs you have to worry about. Going into that, you have different metering systems and protection systems, cathodic protection and lightning protection being one of those main ones. And then also the electrical instrumentation that goes into all of these systems can be very complicated. And I've worked on a lot of companies that have taken some very substantial R&D credits because of their work in this space. And downstream, similar to midstream, we have a lot of facility design and construction and also pilot plant design. I have one client that I've worked with that developed, I think they spent close to $100 million on it. To process material and produce new material. They've been claiming millions of dollars in credits over the last several years as it pertains to the development of this pilot plant facility. And then also in the services space, there's a lot of opportunity for compressor designers and manufacturers. Here at Moss Adams, we have a few of those, and their credits are always close to the 7-figure mark. Downhole tools, whether it be wireline tools, measuring devices, drilling technology, items like that, rig builders and auxiliary equipment builders, chemical manufacturers. We have some clients here at Moss Adams that actually design and produce frac fluids and drilling fluids. And then also software as well. There's a lot of software that goes into drilling rigs, it goes into fracking projects, software developers as well. And it doesn't have to be externally facing software either. The question was about, can our new accounting software work as an R&D project? The answer is yes. It can be internal software development. It just has to meet the rules associated with the 4-part test in order to qualify. Moving on into kind of our renewable space, it's similar to the traditional oil and gas space. There's a lot of design and engineering that goes into solar fields. We're working on a very large client right now out of California that's what they do. They design solar fields. They have all the technology. They have a couple hundred engineers on staff, and that's what they do. And going into that, there's solar cells and battery technology, and also the other ancillary technology that goes into these solar fields. A lot of opportunity in the solar space for R&D tax credits. And some other renewable opportunities, whether it be, I have a client in California that actually designed a facility that accepts rice hulls. They actually turn these hulls into electricity and sell that back to the government. Very complicated project. It's been going on for 4 or 5 years now that they've spent hundreds of millions of dollars on. Very complex and interesting project that I was a part in. Wind technologies as well, whether it be transmission, storage, and hardware, and also just the overall efficiency of all these renewables. And there's a lot going on in the battery space to get batteries to a more efficient threshold to last longer and to be more useful within the marketplace. And then I think finally, this is my last slide. Just wanted to note on the 174 capitalization. So prior to tax year 2022, all R&D expenses were able to be fully deducted in the year in which they were incurred. After that, we have to capitalize them over a 5-year period. Now that was kind of a headache for us last year, both on the tax and the R&D side, kind of figuring all this out. I wanted to bring this up as this is still the law as of this webcast is going on, but I did receive an update this morning that this may be going away as soon as this month. So we'll keep you updated on that. But as of now, you capitalize and amortize all of your expenses, all your domestic expenses over a 5-year period, and then any foreign expenses is a 15-year period. That is my time, and back to you, Lori.
Thanks, Daniel. All right, to round out the tax section, now we're going to turn it over to Clay Hodges, who's a director in our tax controversy group. Clay's going to have some updates on us for what's happening within the IRS, particularly with regard to kind of the ERTC claims, as well as all the money the IRS was given and what they've done and programs they've put in place for that. So with that, I'll turn it to you, Clay.
All right, thanks, Lori. Before we jump into the fun IRS funding updates, I will give just kind of a quick latest developments in the last quarter with the employee retention credit. Here, I'm sure most of you know what you've seen this, know your eligibility or not. But in the last quarter, the end of 2023, there's been some significant updates. First, in September, there was a moratorium on processing new claims, meaning that the IRS is just so backlogged on receiving these claims and going through them that they just said they will not look at them until the beginning of 2024. I'll let you know that the latest developments have been they are still way behind. They are not processing enough compared to the amounts that are coming in. So if you have claims outstanding, all I can tell you is be patient. They're trying to work through them. While they're working through them, it's also because you've probably heard this is an area rife for abuse. So they are doing their due diligence, looking at potential promoters, preparers, things of that nature to make sure these are being done right. And piggybacking on that, in October, they announced a withdrawal process for the ERC claims. So if you had a claim still pending, you're still expecting a refund, you could send them a notice indicating, hey, you are withdrawing that claim. You no longer want that money for whatever reason you decide. And then in December, they issued about 20,000 what they call soft letters to taxpayers. Basically, taxpayers that they didn't think had an eligible business or didn't have eligible employees. In essence, the low-hanging fruit they saw and said, you've submitted a claim, you do not qualify, you will not be receiving a refund. It did have avenues for appealing that decision if need be, but taxpayers can also expect this the first tranche, your 20,000. That was the beginning. The IRS has indicated they will be sending out a lot more letters to taxpayers, and then finally at the end of December last year, they announced a voluntary disclosure program. Basically, if you have received the money, you can enter this voluntary disclosure program to pay back 80% of it, to be exact. You get to keep 20, which is roughly the amount you probably paid a promoter or provider of the ERTC claim. And this will relieve you of any interest or penalties, but you do have to still work with the IRS to answer any questions they have about who you worked with, who advised you, things like that. So I will leave it as if you are thinking about taking the employee retention credit or have a claim outstanding, please reach out to us. We're happy to discuss. There's a lot of involvement here, and the IRS is keeping a close eye on everything. And I think we have another polling question right here.
Fantastic. Poll number 4. Did your company utilize the ERTC? A, yes. B, no. C, maybe. Another friendly reminder that you need to respond to at least 5 of the 6 polling questions, and make sure to hit that submit button so it tracks your CPE response. We'll go ahead and leave this up for just a few more moments while we get a few more responses. And the results.
All right, looks like most people did not utilize it, about 58%. 15 did yes. I will also add with that voluntary disclosure program that there is a very tight deadline to disclose there. I believe it's March 22nd. So it is something you'd have to act on pretty quickly if you want to work with the IRS to return some of that money. Now let's go to the Inflation Reduction Act. I'm sure by now everyone's heard that the IRS got over $80 billion in funding, which was allocated over a 10-year period here. And you can see the numbers right here. The next slide I like a little bit better because it gives you a graph of the increase. So you can see a big majority of it went to enforcement or operations, but also much needed that business systems modernization. If anyone's ever tried to talk to the IRS by sending them letters or contact them by telephone, you know it's a very arduous process and not easy to get through. The IRS has announced that they are trying to catch up and modernize their systems to make it more taxpayer friendly. Next slide here. Also, you've probably heard that in the last year there was about 20 billion of that 80 billion was clawed back, 10 million in 2024 and then another 10 million in 2025. There's been conversations, I know Daniel just alluded to it with the R&D credit. There's a lot of talk about what's going on right now. Basically, at the end of this week, there's potential for a government shutdown. Part of the negotiations back and forth has been this IRS funding. That's a very politically charged area. And so there is still discussion about maybe even clawing back more. But for this in the June 2023 clawbacks, there won't be an immediate impact because it will be for funds that they have not used yet. They've already used a lot in 2024. So it didn't change any of their short-term plans. It's just going to require an adjustment to their longer-term plans. But the important thing I think to emphasize here is with their investment in people, in technology, is they have identified large and complex partnerships as an area they want to focus in on. Some of the stats here, I think the number of partnerships has increased by 32% in the last decade, and partnerships with assets exceeding 5 million has grown by 75%. Here's just another chart. You can see C corporations at slight downtick since 2002, but S corporations and partnerships have seen an uptick in the last couple decades here. Now with the growth of these large partnerships, the IRS has not had the ability to match that with the audit rates. In 2019, it was 0.05% of partnerships were being audited. And the reason for that was just lack of resources and lack of technical capability to dive into these partnerships. On that previous slide where it showed the increase of about 65% in workforce, the IRS has also in the last decade or so lost about 30% of their workforce, and I believe another 30% is at or near the age of retirement. So the increase in funding to provide more resources and more hiring to the IRS, it really would be just to maintain the status quo. They've been losing people left and right, and they're just trying to stay above water there. And so with the growing number of large partnerships and the low audit rate, what the IRS has announced is, let's see, they said they've offered in the last month about 560 job offers to experienced accountants or professionals that could jump in right away and start looking at these partnerships. They've really done an increase in this standard operating procedure. What they've emphasized in the funding is they will increase enforcement activities with large partnerships. I believe in September, they've announced that they've started examinations of the 75 largest partnerships. And then in the next month or so, they're going to send contact letters to about 500 or so larger partnerships, and they're going to start utilizing AI to grab the remaining ones to increase the audit rates, to hopefully try to identify other ones that they want to look at. So this is coming very quickly here. They're improving AI, they're gathering resources, and they're trying to hire experienced people, because in the partnership realm, it's very difficult for one agent to be a subject matter expert on every potential topic that could come up. They need a whole team that could come in and take a holistic view, and that's what they're trying to do here. So they're trying to also use it to understand the completeness, correctness, and timeliness of these structures, education, outreach, and also compliance alerts. And also, I think the big takeaway here, I think I have one more slide I wanted to emphasize, they're going to be focused on helping both partners and partnerships meet their tax compliance, getting it right the first time. They are starting to increase the number of partnership audits, and they'll be reviewing its training and audit processes. And like I emphasized before, gone are the days where it would be one agent that would be looking at this. They would be bringing in a whole team. So if you have any questions about that, we're always here to help. And with that, I'll turn it back over to the group.
Thank you so much, Clay, and thank you to all of our tax presenters. With that, I'm going to introduce Julie Desimone, who's a Moss Adams Assurance Partner and our Energy Industry Group Leader. And Julie will be moderating our accounting section of the presentation. Julie?
Thanks, Lori, and thank you to all our tax presenters as well. So we are moving into our accounting session, and the first one I would like to present or introduce is Mike Carmesino. Mike is going to talk about year 2 for our private companies and what we have to think about for leases, because I guess, Mike, we'd love to say we could forget them at this point and just move forward, but that just isn't the case.
Thanks, Julie. Yeah, let's just jump right in. So is leasing right for me? I mean, now that we're in year 2 of the new leasing standard, we no longer have those practical expedients that simplified the guidance as we transition from 840 into 842. And as a result, there's nuances, complexities in the standard that we need to consider for new contracts, as well as any modification to those contracts that were transitioned from 842. And now that all leases are on the balance sheet, I'm sure many of you have contemplated as you're operating your business whether you should purchase the lease or purchase an asset, lease an asset, or even within the lease agreement have a purchase option at the end. And in assessing those potential decisions, are you looking at them from a business perspective or an accounting perspective? And in my opinion, I think, you know, as you operate your business, you really should be looking at it from a business decision. What's going to add the most value to your business? But it's prudent to understand before entering into those contracts that you understand the accounting implications, just to make sure you're not creating issues, you know, from other agreements that you're entered into. For example, a lot of debt agreements are silent on how lease liabilities are, you know, factored into certain covenants. And so if you have covenants that talk about certain ratios, such as a fixed charge ratio or a current ratio, you know, it would be in your best interest to get ahead of, you know, the potential accounting and talk to a lender or even a vendor who, you know, might be looking at those ratios and come to an agreement on how those lease liabilities that are now on our balance sheet should be captured when considering those financial covenants. And then also, since we now no longer have access to a lot of those practical expedients that simplified the guidance when we transitioned from 840 to 842, there are a lot of accounting complexities, you know, to leasing decisions. Just to like the top layer, right? underneath all of these complexities, there are sublayers that increase the complexity. But we need to first determine, if there's even a lease within the contract. Do you control the asset? If you do determine that there is a lease, what's the lease term? Looking at the enforceable period, what is reasonably certain from the entity's perspective of lease renewals and extensions? Are there termination clauses in the agreement? When looking at control, are there substitution rights that a supplier has? And then lastly, modifications to existing contracts. Is it a full termination of a lease? Is it partial termination? Or is it a new agreement in and of itself? So as you can see, there's a lot of things to consider when entering into new contracts or modifying an old contract. So very high overview here. Lessees are required to recognize all leases that have a term of 12 months or greater at the commencement date of the lease. So you recognize a right of use asset and a corresponding lease liability. The commencement date is different than when you execute the agreement. It's when the asset is available to the lessee. And that determination can be subjective depending on circumstances, facts and circumstances within the agreement. So it may not necessarily be the date in the agreement per se. It could be an earlier date or a later date. So I just want to highlight here that it's not as cut and dry as it may seem. The commencement date may be before or after a date specified in the agreement. And from a very high level, the lease standard is meant to just predict a faithful representation of leasing transactions between both the lessee and the lessor. Likely to affect businesses in all sectors of the industry, whether you do have a lease or not. I think the biggest component to this new standard is the completeness of the contracts and any potential lease within any contract. So it's understanding and making sure you're identifying all potential leases. And then there's a few scope exceptions in the new standard, mainly leases to explore land for mineral, oil, and natural gas resources. Also, in a subsequent slide, we'll talk about land easements, but in order to be a lease under 842, there must be a defined period of use. So perpetual leases are scoped out of the standard. So high level, identifying a lease. You have to have two components in order for there to be a lease within a contract. You have to have an identified asset, whether the contract specifically or explicitly or implicitly specifies the use of an asset, and the entity has to have control of the identified asset for a period of time. And again, period of time is there's a defined period within the contract, and be careful of leases that are for a very long period of time, such as 100 years, 150 years. Although that may seem like an eternity, it's still a defined period of time. Also, leases that have automatic renewals still is for a period of time, because you have to assess what's reasonably certain of renewing to come up with a period of time. So be careful. A lease that on the surface may seem perpetual may not be perpetual depending on the circumstances. Then digging a little bit deeper, going a layer underneath that, an identified asset, right? Either explicitly or implicitly specified in the contract. And then does a supplier have, or the lessor have, a practical ability to substitute the asset? And would it economically benefit from substituting the asset? So in other words, if a supplier could switch out the asset that's in use or mentioned in the contract, that negates there being an identified asset. So you have to assess supplier substitution rights. And then the right to control the use during the lease term. So the lessee or the entity would need to have decision-making authority over the use of the asset, and ability to obtain substantially all economic benefits. And the standard's silent on what substantially all economic benefit is, but there's interpretation that it is analogous to 90% of the fair value that's used in determining whether it's an operating or financing lease. So essentially, the entity would consume about 90% of the fair value of the asset's value. And then analogous to control is the same definition used in ASC 606 or 810. Okay. So lease modifications, I think this is probably one of the biggest things to consider as we go into year 2. All the existing contracts were assessed under 840 came over as either operating or financing leases using practical expedience. But as soon as that existing contract is modified, you have to assess whether it's a new contract and should be accounted for separately, or if it's a modification to an existing contract. Modifications, a modification that would result in a new contract is you have additional right of use asset and the lease payments increase commensurate with the standalone price for the additional right of use asset. If those two aren't met, then it's a modification and you have to reassess the classification, remeasure the lease liability, and adjust the right of use asset and lease liability. And if you have a modification that fully or partially terminates an existing lease, you have a gain or loss between the difference of the right of use asset and lease liability. A couple easement considerations here. If you have a payment stream, you have to consider it for a lease. Again, easements need to be assessed for whether there's a lease term or not. And a lot of times land easements have terms that are longer than your normal 10-year, 5-year agreements. They could go out as far as 100 years. And in that case, if you have a lease for an easement that is a very long term of say 50 plus years, you have a discount rate that is very likely hard to estimate because not many people loan on greater than 30 or even 50 years. And so it'll require a lot of estimation and judgment from management. So I just encourage, if you get to that point and you see a lease that's an easement that's a very long term, that you start conversations early internally as well as any external party that might be impacted. And then power purchase agreements, things here, same as the rest of the guidance. You have an asset and control that need to be considered. Remember the 90% rule, that is controlling substantially all of the economic benefit of the asset. And then control could also be capacity in a purchase power agreement, or even controlling benefits such as renewable energy credits. A couple things here, fixed payments in these agreements likely would be considered a lease if you meet the other two criteria of control and an asset. But if variable, it's likely not going to be a lease. And a couple examples here really is, if you have a power plant as an identified asset and the entity has the exclusive right to purchase all the power produced for the period of use, likely there's an identified asset and there's control in place. That is my quick summary of leases. If you have any questions, please feel free to reach out and I'll turn it over to Julie.
Perfect. Thanks, Mike, very much. Okay, the next one that I'm going to cover is CECL. Now, CECL, I've heard a lot of people throughout the industry have really been talking through this, saying that it's not going to have an impact on the power companies, on utilities, on oil and gas, on any energy and utilities companies. And unfortunately, I think if you can get one thing out of today's session, I'm here to tell you that probably isn't true. So there is something we have to do. This was definitely a standard that was made for banking financial institutions, or has a much heavier impact in financing type companies, but it isn't something we can just ignore. So I have a few slides on this and going to go pretty high level with this. However, I think the one thing I could tell you is please, please, please reach out to your auditors and see what you need to do as you move into the year-end engagements. So what this is, it's a principles-based standard, and it really looks at your losses. So it's trying to say, how do you estimate your losses, which primarily for us is going to be our allowance on doubtful accounts. What really it's doing is it's taking away historical only impact. So you don't want to just look at things historically. We're trying to take a look at things prospectively and look out into the future. This is a big slide, and it really gets into loss estimates and how we're thinking about it. It does stand for current expected credit loss. And again, I think the impact, or what we're trying to say at this slide, in this presentation, is really it's something we do have to evaluate. Not that we're expecting it to have a significant financial statement impact, but it is still something that has to be evaluated as you move through your year-end engagements. So let me get to the really important part of this. This is just some additional slides and information, but this is the one that I really want to key in on. And it's because this is what brings into the scope of the standard. And the very first one is probably the most impactful to the majority of our entities. Contract assets and trade receivables. So if you have trade receivables, if you have contract assets, then you're going to have to bring this into scope. We're going to have to talk about the CECL model. Here's some additional ones. If you happen to have held to maturity or available for sale debt securities, loan commitments. For some of our utilities out there, if you have any lending programs, it's something that will have to be considered. So what do you have to do? What you have to do is really take a look at how you evaluate your allowance for doubtful accounts in primarily our trade receivables, and not only look historical, but come up with a methodology that looks prospectively at all. So take a look at what's going on in the future as well as the past. So really, I want you to contact your auditors and find out what type of documentation, what kind of evaluation is going to be required by your auditors as you go through the evaluation of the CECL standard. Agreed. I already probably stole my own slide. Trade receivables are going to be the most common instruments to apply to CECL. And we want to give you some examples. So the greatest thing in being a private client or private company is we get to look backwards, or we get to look to our public companies because they've already had to do this. So we gave you some examples that are publicly traded companies that have the information out on the internet of two different methodologies that were utilized. So feel free to take a look at those in determining what your CECL strategy is going to look like. All right, this is just a final wrap-up slide in looking at it. Again, historical loss alone cannot be our evaluation on trade receivables. We have to look into the future as well. There are a couple of new disclosures, and we actually expect this probably to be our most primary impact, primarily in your allowance for doubtful accounts accounting policy. So how does that look, and is that in line with your new CECL standard? So Danielle, I'm going to turn it over for a polling question.
Thank you, everybody. We're at poll question number 5. Has your company started assessing CECL? A, yes, almost done. No, I'm sure we don't have to. C, no, but now I'm worried we may need to. D, what is CECL? We have great questions coming through for our presenters. Please send us any you may have regarding the material being presented utilizing the Q&A window. Though we're heavy on content today, we will do our best to follow up with any questions you submit after the webcast. And I'll go ahead and leave this up for a few more moments to get those last second responses. And the results. Julie, I'll pass it back to you.
Perfect. Sounds good. The no's, I'm glad, that's exciting, but again, definitely look at the impact, and if you do have those trade receivables, know that that's something we have to consider. All right. I'm going to turn it over to Christian Hansen. Christian is a partner in our consulting industry group, and with our cybersecurity. Christian, want to talk a little bit about some ESG or SEC cybersecurity disclosures?
Yeah, thanks, Julie. So most of you probably already saw these disclosures that came out, the disclosure requirements that were released last year. I wanted to go through a little bit of the background behind this. dare I say, this is almost like cybersecurity's Enron moment, maybe not quite on that scale, but pretty significant as far as the fallout that's coming from it. So 2019, 2020 is when the breach occurred. This is with SolarWinds. Again, you may have heard about this. SolarWinds has a number of products. One of their flagship products is called Orion, and Orion is a infrastructure monitoring platform. So your IT folks can connect in a whole lot of different tools to it, and they can monitor everything. Cloud tools, your on-premise tools, anything. So gives you the scope of what Orion can see. September 2019, bad guys breached the SolarWinds network. And in October 2019, they did a test run of pushing code out into the Orion product development pipeline, and it was successful. They decided to push malicious code out into that pipeline in March as people were getting their updates from that product. They got all those updates that had the breach in it, and then it wasn't until November that one of their clients, FireEye, noticed that they were having some security issues. FireEye is also a security company. And then in December of 2020, SolarWinds notified the SEC about the breach. So you can see it was almost a little more than a 12-month runway between when the breach occurred and when the SEC was notified of the breach. From that, there were about 18,000 estimated entities that were impacted, some very large United States federal government entities, some very large corporate entities on the list, all folks that, there's kind of a reasonable thought that they probably have things buttoned up. And they were all breached as a result of this. So what's happened since then? A lot of things have happened. It's taken a bit of time. In June of last year, the SEC issued a Wells notice to the CISO at SolarWinds, basically notifying him that, charges, basically saying charges were coming. Since then, charges have been filed against that CISO about the state of their security program. Out of all of this, and it was probably running concurrently, the SEC has been working on the cybersecurity disclosure rules for publicly held companies. And it's really kind of two-part, the new rules. So one, there's a cybersecurity program reporting rule. So in Form 10K, there's a section where they, to keep it simple, they want you to tell them, what are you doing around cybersecurity? What does your cyber risk program look like? How are you doing it? What are you doing? If you're not doing something, disclose that. So they want to know what the program looks like overall. And then the other thing that they added into the new rules was incident response to disclosure requirement. The rule now says that you have to disclose any material incidents within 4 days of determining that the incident was material. There's a carve out in there that if the United States Attorney General says that this is national security related, you don't have to disclose it publicly. So these two things, these two rules kind of imply some things. One, you should have a cybersecurity program in place, and two, as part of that, you need an incident response program that can move quickly. 4 days is a short amount of time. There are reasons historically why cyber programs would not disclose things publicly, largely because if you don't know how to fix it, it's sometimes bad to raise your hand and say we have a problem, because that can lead to additional exploits of whatever problem is out there. So the big question is, what do we do about it? This is how we approach it. This is how I would approach it. I've worked in cybersecurity consulting for a while. First thing I would do is pick a framework. There are a lot of cybersecurity frameworks available to choose from. The NIST cybersecurity framework, although sometimes called the CSF, was explicitly designed to cover critical infrastructure parts of the United States economy, energy being one of those. So there's 108 currently in version 1.1 of CSF, which is the current version. They're working on 2.0. There are 108 what they call subcategories that effectively are controls that you can apply throughout your environment. Once you've picked your framework, figure out where your scope is. If you do any sort of financial audits, if you're public, you deal with Sarbanes-Oxley. The trick with SOX and applying SOX is the scope of SOX is to your financial reporting things, which may not be the total exposure for your cybersecurity risk. So cybersecurity risk is likely going to be bigger than your SOX footprint. If you have a SOC report or some other security compliance things, again, you're probably covering portions of what you need to. It may not cover your entire scope. So pick a framework, define your scope. Once you define the scope, then go through the framework that you picked and said, okay, here are the controls we're going to put in place against that scope. Once you've got controls in place, have somebody come and gut check them. Independent third-party validation is really important because oftentimes there's different interpretations of the controls or how they are applied to an environment. It's a good way to get outside views of what you're doing. And then last, report it. So wrapping all of these things together into some sort of report that can go to your board, to your executive management team. This is really the controls way of looking at this. The other thing you should be doing is an enterprise risk assessment. So this is a control-centric process that I just described. The risk-centric process takes a different approach where you're going to say, what are the risks that our organization faces? Once we understand those risks, we'd call that inherent risk. You're going to have controls that you've applied now. You can subtract the risk level, subtract the control impact from that risk level. That gives you a residual risk. And then you have to decide what to do about your residual risk. Are you going to accept it? Are you going to transfer the risk with insurance? Are you going to apply more controls to reduce that risk to another level? Whichever process you choose to take with your risks, the key is to getting board and executive management on board with the decisions and making sure everybody's marching to the beat of the same drum. This is just another kind of some more slides on things you can do around your risk assessment, but the general process I think we've already talked through. So the NIST CSF, I'm not paid by NIST to say this. I think it's a good framework. I think most of the folks in the energy industry would benefit from this if you're not already doing something similar. The 108 subcategories, these are the 16 critical infrastructure sectors of the economy that CISA, the U.S. Cybersecurity Infrastructure Security Agency, is defined. So this is really just there as a help. So go through your risk assessment, define your risks, pick a control framework to mitigate those risks, implement the controls, have someone come and assess them. And as part of that, you're going to want to look at external security assessment. This is something that my team does, other people do, you can do yourselves. But my recommendation is have someone come in and again look at this. Make sure that you're meeting the standard and have that external reporting in place. There's a few different reasons why you want to do this on a continuous basis. Usually it's an annual frequency. Sometimes it could be more. The cyber landscape changes constantly. There's new software being released all the time. There's updates to that software being released, even if your software itself stays static. New vulnerabilities are constantly discovered and work to be exploited against your tech stack. Your IT department's going to change. It's going to grow. It's going to morph. You're going to combine, businesses. You're going to acquire somebody, divest things. Personnel are going to change. All of those things are going to impact your cybersecurity landscape and your risk landscape. So staying on top of that and having that regular assessment check-in is going to be helpful to make sure as the landscape shifts that you stay on the right side of things. As far as your scope goes, you have to think about your network architecture, firewalls, intrusion protection and detection systems, servers, individual laptops and workstations. There are a number of areas within the cyber realm that you should be considering and having controls around. And if you go through your risk assessment today and say, we have a long ways to go, that's okay. You can build out a multi-year attack plan to implement controls as you can as you invest in that over time. Second part, incident response plans. You need to have a pretty robust incident response program to meet the SEC's requirements. There are a number of publications that are out there that are publicly available that can help with this. NIST has a publication in their 800 series that can walk you through how to do this. Most people will take that as a baseline and subtract from it or add to it based on their own needs. But there are some general things that you want to be aware of as you build that program. And again, I would look to external sources. There's a lot of content is already out there and available that's very good. So there's no need to reinvent the wheel. You just need to apply those things. Last thing to do is do penetration testing. Do it at least annually. You probably can't do it frequently enough, quite frankly, except for paying the bill for it. Have good guys come in and act like the bad guys and see what they can break. Because again, you're going to have, you're implementing new software, you're patching your software, new vulnerabilities are coming out on existing and new software. People are changing, processes change. All of those things can expose you to risk, and a penetration test is a good way to test your technical and in some ways the social aspects of your security within your organization. So the next polling question.
Thank you. We are at our final polling question of the day. Has your company completed a penetration test in the past year? A, yes. B, no. C, no idea, but I think we need to. D, no, we are completely safe. Once you have completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And we'll allow a few more seconds here for our audience to respond. All right, we'll go ahead and forward it on to the results.
All right, thank you. I think I'm at time here. So just a few other, penetration testing is important. There's some more content in here that can help guide what that looks like. Your organization will have specific needs that'll need to be met. So the key takeaways: incident response, risk management. There's some timelines in here that explain what those look like that will be helpful. And I'll close it there.
Thanks, Christian. I completely agree. This is becoming more and more important as we move more into the data age. We do have a few individuals on the phone that are GASB followers, so we just wanted to put out as our very last subject a couple things on the GASB standards. It's the big three liabilities. GASB continues to be really focused on the liability section of the balance sheet. And for the current year, leases were implemented last year. This year, it's the PPP and the SBITA. These, if they're not on your radar, we do expect in the industry, the SBITA one, that's the subscription-based information technology arrangements. It's essentially the leasing standard for IT arrangements. So again, it's something to make sure that you consider. It's very similar to the leasing standard and very similar other than you're inventorying a different set of contracts. So you're inventorying the IT subscription contracts, but then you essentially apply a lot of what we did in GASB 87 to those subscription-based IT arrangements. So again, make sure those two are on your radar for the current year. And then we'd also like, in wrapping this up, we'd also like to introduce or talk to you a little bit about an ESG and upcoming webinar. So we do plan on having a webinar. I think we've actually set the date, March 5th, 2024 at 10 o'clock Pacific time. It'll be talking through navigating the ESG trends in the energy sector. And that'll be a good webinar, so keep that on the radar. I encourage all of you to be watching our website and signing up for as much as you want from these webinar content. I think all of the presenters that were on with me today really appreciate that quick, high-level tax and accounting update. We do plan on holding some more in-depth webinars here in the future, and then a longer webcast in the probably August and September timeframe, going into some of the more deeper issues. So I will turn it back to Danielle to close out our webcast.
Thank you, Julie, and thank you to all of our presenters today. To our audience, if you have any further questions or comments, please reach out to us, as we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to our team or any of our presenters directly. Their contact information is in your console. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks if you have any difficulty downloading it now. I want to forward us on to some resources. before you go. And finally, here is a link to the survey for today's presentation. Your feedback is appreciated so we can make the most of your time with us. Thank you again for joining. Take care, everybody.